Thank you everyone today for joining us to hear about our implied volatilities in Greek feed. My name is Jeff Soule. I'm the head of market data at the ISE. I also have Gerald Hanweck of Hanweck Associates participating today. Jerry spent over 10 years of his career with JP Morgan. The last 3 of his years there, he was the chief equity derivative strategist. And Jerry's been out on his own now for several years, and he has a very strong background in quantitative analytics and technology. You can see additional information about Jerry on his link here on the website. Okay. The ISE Greek feed that we're going to discuss today is actually a joint offering between the ISE and Hanweck Associates. The ISE first subscribed to this feed about 3 years ago. We integrated the implied volatilities Greek data into our front-end trading application. So it's not actually a new feed itself, but a new feed offering to the ISE. All right. So here's an agenda of what we're going to cover today. This webinar is going to last about 25, maybe 30 minutes. We'll have questions and answers at the end. So if you do have any questions, please enter them in the Q&A box on your screen, and we'll hit those up at the end of the discussion. All right. So I've covered the intro. Let's move on here. Okay, so this is our standard disclaimer. Options involve risk, and everyone can get a free copy of the characteristics and risks of options by calling this number here or logging on to the OCC website. And most importantly, we are an exchange. We do not give any investment advice. Any examples or ideas are just for illustrative purposes only today. Tab Group, which is a research firm, did an extensive report on opera data in October, just 2 months ago, which was a very interesting paper. The point that I want to make is a statement they said that basically the amount of opera data is constantly increasing, which requires additional investments in the infrastructure to support this big data set. And as Tab points out, this cost of upgrading and expanding the market data infrastructure is and will continue to be a costly proposition. Right? Just processing this amount of real-time opera data is challenging itself. Many of you probably realize that already, but producing derived data in a real-time format is even a greater challenge. And what we're going to talk to you today about is a product with institutional quality data for a price that's cheaper than you could do this on your own. Let's take a look at exactly some of the growth of opera data that we've seen. Just to be clear, opera message is either a trade or a quote. Essentially, there's billions of messages a day. We've seen over 5 billion quotes per day on average this year. However, the largest single day of the year was over 14, almost 15 billion messages in a single day. So it's obviously a lot of data. Another metric that we happen to look at, not only are there a lot of messages, but the update rates that Opera pumps out are faster than any other exchange data that I've seen. And although you'll see here on this chart the peak 1-second messages for this year are around 2.5 million messages per second, the peak message rate for the year is closer to 4 million messages per second. The month of October alone had 17 out of 21 days with peak message rates that exceeded 3 million messages a second. And there is no let-up in sight. By July of next year, Opera's projections are for up to 9 million messages a second and 24 billion messages a day. The implied volatility in Greeks themselves are very intense calculations, and there are many firms that simply cannot keep up with calculating this data anymore based on the message rates that we're now seeing with Opera. And this is really the main reason that we're introducing this feed and making it available as an exchange-offered feed. What I'm going to do is I'm going to turn this over now to Gerald Hanweck, and I'm going to let him provide some specific details about the feed. And again, if you have any questions as we go along, please type them into the presentation, and we'll answer them at the end.
So the ISE Implied Volatility in Greeks feed is a streaming data feed of real-time low-latency implied vols and the risk parameters. Importantly to note, it's all of Opera, even though this is an ISE offering. This is covering all of the options in Opera. It includes adjusted options, those that have gone through a corporate action adjustment, that have potentially deliverable basket, multiple securities, cash deliverable, non-standard units, multipliers. So we cover all of the options that are on the Opera, sorry, in the Opera feed. The methodologies that we use are pretty much industry standard. For calculating all of our option prices, we use a binomial tree model. This handles the American-style exercise in a fairly standard way. We also use the same model to cover our European-style options. This keeps the calculations consistent. The thing about implied volatilities in Greeks, of course, is usually the inputs determine a lot about the outputs. So some of the key inputs that we have here are our dividend forecasts. We use discrete dividends, actual forecasts from top-tier providers, including vendors such as Market and other groups that provide dividend forecasts. These are discrete dividends, again, with the ex-dividend date and the amount forecast out. We use real-time interest rates and intraday time decay. Our interest rates come from the Eurodollar futures market, which we're calculating effectively a LIBOR rate for every expiry. These are being calculated in real time. Intraday time decay is particularly important as we're looking at the weekly options and shorter dated options, where the intraday time decay has a great effect on the price. One of the things that's become much, much more important, particularly in the last few years, to evaluating options is getting the hard to borrow or the rebate correct. We have a proprietary method that we've developed that implies this hard to borrow rate from the options market itself. We run this calculation intraday and apply that hard to borrow calculation as part of the inputs into the binomial tree model. So to summarize, the binomial tree model we use allows for discrete dividends, an interest rate curve, and borrow curve, and handles, of course, American style as well as European style options. Content of the feed is your standard Greeks. We include mid-market, delta, gamma, theta, vega, and rho. We include the Opera bid and ask price and size at the time of the calculation. We also include the underlying bid and ask price at the time of the calculation. So in each record, for each option, you end up seeing all of the Greeks plus all of the underlying option price that went into that calculation, so that you could, if you wanted to, replicate those calculations yourself. We also include some additional information, including the forward price that we use out to that option expiration. We include some information about the borrow amount, various timestamps, in particular the timestamp associated with the calculation. And in fact, each message that comes out of the feed is one option with this information about the Greeks, the bid-ask price for each of the underlines. An issue that arises is because we're including real-time, in fact, low-latency real-time bid and ask prices for the underlines and for Opera, those messages can become fee liable from the exchanges. So, for example, an option on a New York Stock Exchange stock, if we include the underlying bid-ask price in the feed, that price is fee liable in ISE. So what we've done is we've broken the feed up into different groups. And Jeff, I think, will touch on this a little later, but in essence, you can pick and choose which underlying equity exchanges and even all exchanges you want to include and exclude in the feed. So you can say, I'm happy taking NYSE, NASDAQ, and Amex underlyings, but I don't want to pay for NASDAQ indexes, or I don't want to pay for NYSE indexes, or I don't want to pay for Russell Tick. And so you can turn those on or off in the feed. In other words, we can permission from the exchange side, permission that in the multicast, or that can be done through your data provider. But if you choose to take the feed that includes Opera or one of the exchange bid-ask prices in it, then those will be fee liable. I'm going to turn it back over to Jeff at this point.
Okay. I'm going to go through some more bits of information here that I think are going to be useful. One, obviously, how do you access this data? We have redundant infrastructures built out today at the Equinix data centers. So the data is available through a cross-connect if you are already in one of these co-location facilities. And alternatively, the feed is available from a number of extranet and managed service providers. There's probably 40 to 50 extranet and managed service providers that connect to the Equinix data center. So there's a lot of access points to get into the data and provide it. But again, the primary data center that we're using today is Equinix and the Pocket. Bandwidth requirements vary. As Jerry said, it depends on what exchanges you want permissioned on the feed. Obviously, we're using real-time Opera and level 1 equities data for these calculations. If you take the feed with all the exchanges turned on, you'll need around 350 megs of bandwidth. If you take it with just the base implied volatility Greeks data with no exchanges turned on, it's about 250 megs bandwidth. And again, any of the real-time feeds that you want turned on, in other words, if you want to see the bid and offer the size of Opera, the Opera quote, you simply pay an Opera fee. If you want to see the underlying prices, then you simply pay that corresponding exchange fee. The subscription fees, I don't want to spend a lot of time on subscription fees. The subscription fees are listed here on the website. I don't want to waste people's time to discuss fees at this point if you're unsure about the fee, but the fees are listed there. Essentially, we have a pricing model that accommodates both internal use or external distribution, and both for professionals and non-professionals. So again, if you have any questions about the fees, if you're interested, if you're at that point, give me a call or send me an email, and I'm happy to discuss the fee structure with you, but it is posted on the website there. All right. So in summary, what I want to do before we get on to questions, I want to make just a couple points. Okay. In summary, basically what we have here, it's a real-time feed, the low latency feed of implied volatilities in Greeks, and as Jerry said, for full Opera, not just for series listed on ISE, it's for full Opera. We actually use Opera and VBO in the calculation. All right. The model itself has been deployed in the industry for over 3 years with a number of professional subscribers, a number of different firms. ISE alone has hundreds of end users that access this data in Precise, which is our front-end application. Many of these professionals have provided valuable feedback over the years that in some cases have even led to enhancements in the feed. So the feed is actively managed by Hanweck. As far as the model goes, they've done a really good job with this, and ISE is very happy as a customer. So I guess most important is this data, this feed itself is now available as a cost-effective exchange feed. It's an ideal solution for whether you're a trader, a broker, whether you're risk managers, whether you're independent software vendors. It's an ideal feed for many types of users here. And again, this is all institutional quality derived data. All right. So let's see here. Oh, one thing we mentioned on the invite is there would be a free sample of data available for people that participated on the webinar. Again, if you're interested, shoot me an email or drop me a call. We'll send you a file that will provide a sample of this data. And then the next thing we want to do is we want to go over any type of questions or answers that we have. All right. So at this point, again, if you have any questions, please enter them either into the the chat window or the Q&A window, all right? First question we have here, Jerry, you want to take this?
Yeah, so the first question is effectively, do we put out vols and Greeks on a calendar day or a business day basis? Currently, the feed puts out a calendar day basis. We're looking at doing a second feed or extra fields in the feed that would include both calendar day and business day. Really, we're going to gauge demand on this. We've done some research at Hanweck Associates on this topic, and certainly in the last few years, we've noticed that the volatility attributed to weekends and holidays and after the close, et cetera, the volatility that you can attribute to those periods when the U.S. market is technically closed has actually increased quite a bit. It used to be you could view a weekend as very little, very little volatility, but now I think in particular with various governments around the world, including ours, their penchant to release information on weekends, and that's certainly driven a lot of the increase in volatility over the weekends. And obviously, as markets become more global, U.S. closing times matter less and less. But in a nutshell, right now the current feed is a calendar day basis feed, and subject to demand, we'll figure out a way to put business day in there if there's a need for it. Another question that's come up is, what triggers calculation? In other words, what are we calculating vols and Greeks on? Basically, any change in the underlying stock price within a particular threshold, which is set to a couple pennies at this point, 2 pennies. Any change in the underlying stock price of that size, or any change in the bid or ask, will trigger a recalculation. So any change in the underlying stock price will cause the whole chain to recalculate, and any change in an options bid or ask price will cause that option to get recalculated. And of course, the timestamps in the option bid and ask and the underlying bid and ask get republished when those calculations occur. Third question is, what is the format of the feed or the API? The feed is a fast format feed. It's very similar to other feeds that the ISE puts out. I think anybody who is currently taking an ISE feed or an Opera feed are going to find this to be fairly easy to program to. We have some sample code that for subscribers, if they want to use the sample code to parse the feed, that's fine. Again, Jeff can handle questions around sample code and data formats and programming guides and so forth.
All right, if there's any other questions, you can send them in now. Otherwise, that answers the questions that we've had at this point. Again, there'll be additional information added onto the website. We will be putting up a programmer's guide there for those of you that are interested. And again, if you're interested in a sample data, a free sample of the historical data that we have available, I'm happy to provide that as well. At this point, I don't see any other questions here. No? Okay. So that's it for now. Thank you, everybody, for your time. We appreciate your interest and hope to be talking to you soon. Thank you. Bye-bye.